Hi, I'm Michael Owen and I'm thrilled to join Weeks as their global brand ambassador. In football, success comes from precision, speed and strategy. Every move matters. With 1,000 plus trading pairs, you can trade spot, futures and more. And security? Weeks leads the way with Plus, a 1,000 Bitcoin protection fund. Join me on Weeks, where new wealth is made.
Alrighty, this is Adrian Zlunchik, CMT, Charter Market Technician, CryptoBurp. Welcome to day 5 of our Trading Congress. This is Trading Congress 2025, the 7th edition of our annual trading virtual bootcamp designed for traders, especially after a lot of hardships to help them get back on the feet, to help them, well, stop getting wrecked in the first place before they even, think of recovering truly and going well beyond, because in the end, a lot of people have suffered this year. A lot of economies have suffered. A lot of countries are in difficulties. A lot of people are losing jobs, and this is the hardships. This is the reality that we are facing as of the end of 2025, as we're heading into the end of 2025. True, there might be some promising upticks in the market ahead. However, the conditions, the reality isn't looking as much, well, I should say, as good as many people would expect. There are a lot of distortions. There's a lot of turmoil that happened early this year, a lot of unpredictable situations that make it very difficult to navigate through the deep waters of cryptos and of other markets. And to help it better, to make it easier, we invite top leader class, the world-class leaders, portfolio managers, institutional great people, hedge funds, people with thick skin in the game, basically people like our today's guest, Franco, we're going to check on in a second. However, before we do, this is a huge shout out because I welcome each and every single new trader with that hardship in mind. If you are here, you're born in the storm, basically. You're born in a very difficult time. However, it gets easier potentially from here, especially if you have the right guidance. And this year's Congress edition is supported and partnered and sponsored by our incredible friends at We Exchange at Weeks, as well as Ajax. And so you're going to have a proper amount of bounties basically up there, in the link video description. Make sure we go ahead and check it out. There's a lot of bonuses waiting for you. But before we go, before we have a proper kind of like a show of of what's really ahead, for the markets, I want to welcome our today's guest, Frank Capillari, who is here, who I got a pleasure to meet the other day at a CMT symposium, and ever since I've truly admired his work, looked up as an incredible professional. How are you feeling, Frank?
Adrian, great to be here. Thanks so much. I've been watching all of the interviews over the last few days, so hope to add some more content to your audience as well.
Thanks so much, Frank. As always, to the point, as always, very professional. I've always admired Frank ever since we met. Not only he's a very tall and very big guy, in terms of anything profession, anything, that regards markets. He owns both of the CMT and CFA grades. Designations, which is pretty rare in this space. Me being the only CMT in Poland is already rare. However, the combination of CFA and CMTs is extremely rare, right? And that speaks for a lot of wisdom, which sets the expectations very high, Frank, for today's session. So we have a session about the proven framework for identifying uptrends, and we have a whole bunch of examples. So why don't we start off with a brief introduction of how you got basically there to designing your own frameworks.
Sure. Well, as we'll go through, it's really about going through decades worth of trading and analyzing the market. And so, you and I are both CMT chart holders. It's been great. But what we're going to talk about, you really won't find in the CMT material. Now, I stress everyone who has interest in technical analysis and becoming a great trader to go through the CMT material. Because you learn so much of what's out there. And in the end, you probably only utilize a small percentage, but you need a breadth of knowledge to understand what that is. And of course, you get to meet some great people like Adrian, right? We met, I think, 2.5 years ago in New York. And, I know you made a lot of connections over those time frames, and, we've kept in touch along the way. And so, I got started way back in 1997, and we have some charts. I didn't want to just go through my bio, kind of wanted to show everyone the different positions I had over the years, which is in the presentation, to give you an idea of how these traits came about. And it really takes, enduring bull markets, bear markets, choppy markets, as an analyst, as a trader, both as someone who just started and now a veteran in the industry, all that together, help shape how you look at the market, how you trade. Sometimes you have to go through a lot of those tough times and get burned on both sides to understand what you should be doing and the rules that you should be following.
Yeah, I love it so much, and well, I couldn't agree more, right? Because in the end, just like you say, it's a lot of years of hard work. What many people see, and that's very often the illusion that it's very easy, right? That there is some sort of like a quick rich get rich quick scheme, if you will. That there is some holy grail, that is gonna get you like 101% guaranteed win rate. That is some special chart pattern in the book that they're going to read, that in combination with RSI and MACD trending in whatever direction, they're going to have basically infinite amount of money just waiting for them to pick it up off the floor. Well, surprise, that's not how it works, right? There's a lot of like I said, hardships. There is a lot of down days. There's a lot of down weeks and months that truly build and separate the boys from the men, if you will. And well, our today's guest, Frank, is definitely the latter is definitely very, very big of a veteran, I should say, in the space, with many years of experience, especially on having this chartable framework. So why don't we kick off with a little bit of explanation what your framework truly is?
Sure. I'm going to share my screen now. Is that good?
Please do.
Okay. Let's get to this. All right. Okay. Obviously, thank you again, Adrian. And so we're going to go through the 5 traits of an uptrend. But, before we do that, again, this is all about experiencing this over the course of a few decades. And, I'm a little older than probably some here guests. I got started in the industry in 1997. And Smith Barney was a name back then that many people may recognize, but is now part of Citigroup. So during 1997 in the United States, a very good job market. So I was able to get 2 job offers from Smith Barney in the research area. One was technical analysis. One was to be the assistant for the automobile analyst. So 2 interesting concepts of potential jobs. Now, I didn't know anything about technical analysis at the time. Remember, this was like really before the internet even came about, which is crazy to think about now. But I did know what I didn't know, which was what the market was really about. And so I ended up making the decision and joining the technical analysis group. Now, again, I didn't realize that 2 of the people that are running the group were technical analysis pioneers in the industry. Alan Shaw and Louise Amata, probably know those names. Louise is still at it and still keep in touch with her. Wonderful woman, wonderful analyst. So anyway, as we can see here, 1997, what strikes us here is that it was in the middle of the internet boom and eventual bust. So when I got there, of course, the market just continued to move higher. And so again, coming out of college, starting in the industry, you step in the middle of 1997. There was 2.5 years before this and 2.5 years after of just an uptrend. So going through the CMT process during that time in the CFA, I thought one thing, that being overbought was the greatest thing possible because it just meant the market continued to move higher. So I stayed there for about 3 years and then went to Instinet here. Instinet is the electronic trading arm of Nomura, the big Japanese bank now. And when I got there, I was still a junior analyst. But this time, instead of sitting within the research group, I was now on the trading desk in the middle of all this, right? Testosterone all over the place, these traders making tons of money in their 20s and 30s, riding this internet bubble up. And of course, I got there literally, Adrian, the week before the NASDAQ bubble popped. So then next 3 years was dealing with the bear market. And of course, overbought wasn't exactly the best term to use at that point. Number one, we didn't see it much, but anything that got extended, of course, was just a bear market rally, and things then of course, fell apart. And so again, first 6 years of the business, bull market, bear market. So I learned a lot during that time frame, but also was utterly confused because the indicators that worked in the past don't now. Right? And of course, then you get to January 2023. And the reason I had that highlighted there is because I got an offer to be an institutional sales trader at that point. So I was still looking at technicals, but it really wasn't my focus. My focus was growing accounts. And from that point, after the market bottomed all the way through the Grand Financial Crisis, it was a pretty good time, right, for the market, for clients, for brokerage firms, so forth and so on. But as we know, it only lasted for so long. Great Financial Crisis changed everything. Living through it, from my experience, right, there was a triple whammy, right? Seeing my own personal accounts go down, seeing our clients, some of them blow up, and probably the most scary part of that whole process was watching other brokerage firms just end, blow up overnight with no warning. So really thinking that that could happen every day was obviously a harrowing experience. But coming out of that, April 2009 there is I have highlighted because that's when I really thought, not that it was easy at that time, but there's plenty of money to go around. Now was going to be difficult. Fewer clients, right? People were nervous. So I wanted to differentiate myself once more. So started doing more technical notes. And so that lasted, started to grow that much more, got some more requests from people to talk to their clients, not just the ones on my pad. And in 2014, the gentleman who hired me left the firm, and I then assumed both the title of chief market technician and senior sales trader. So a lot of responsibility, which was great because I started talking more to the press, more to buy side analysts and portfolio managers this time. So a much more higher level. Get to the point though, I couldn't do both. And I realized that I was much better off as an asset to the firm and my clients to move off of the trading desk and become just the chief market condition analyst, right? And that lasted for a while. I was in the research desk and then eventually became a desk strategist, again, just focusing directly on the content. And along the way, I started getting a lot more requests from people outside of Wall Street. So financial advisors, just, traders that had an active interest in the market, like a lot of people, involved with Burb Nest, the crypto burb, right? People that want to trade for themselves. And so that's what gave me the thought to do this independently and open up Cap Thesis now, which I did. You can tell they're right near the bottom in 2022. I wish I could tell you that was perfectly timed just by coincidence. But again, going through that last bear market back then, we had to change our thoughts once more. And obviously, we know how things have gone since that point. So as you can see, different roles, many different markets, and having to understand, again, which tools to use within any trading environment, whether it's an uptrend, downtrend, or just a really choppy trading environment. And that's how these 5 traits were born. And as I'm about to show you them, these are all related to the S&P 500. And you can take these and parts of them can be associated with stocks, ETFs, different asset classes, and I'll show you specifically how I use this for Bitcoin as well. So the 5 uptrend traits are this, right? What needs to happen from a pattern perspective? Classical chart patterns, you need to see breakouts. Pretty self-explanatory, but that's how uptrends really are constructed. And you think about how clean breakouts work. You need low volatility. You want a clean breakout, meaning that stock market or stock or crypto goes through a resistance level. It doesn't really come back down to test it. Or if it does, it's slight. And so if that happens, of course, that can lend to more bullish patterns being formed and having their upside targets hit, again, leading to an uptrend. And so that means you want a low frequency of big moves. So I track this using just 1% moves on a rolling monthly basis for the S&P 500. If even that's the case, you still want more gains and losses. You just want more buying underneath the surface. And on a very intraday basis, you just need to see good closes. And I'll talk about how, as a sales trader, especially involved with trading algorithms, helped me really identify this as a quality. And of course, what doesn't work in uptrends, bearish patterns, meaning consolidations are not resolved to the downside most of the time. Very simple, but very powerful as well. So let's start with successful bullish patterns. Okay, this is just a chart of the S&P 500, through the end of October. And, as we know, it was, market floating higher for a bit through the end of 2024 into the beginning of 2025. then the tariff tantrum, then the V bottom, now an uptrend. So if we just look at this, right, this is the rawest form you can find of stock market. It doesn't look like too much, right? It just looks like basically two different trends: downtrend, V bottom, uptrend. But that, of course, doesn't tell the whole story. And when this happens, especially this high volatility period like this, doesn't look like anything, it's just craziness. You need to really zoom in to understand what's going on. Because this particular point here, if you recall, right, this was those last 2 days or those first few days in April, then Liberation Day, so forth and so on. So it just was a wild time. In fact, if you go through that particular week from April 7th to April 11th, and you put all those moves together, that was a huge, like basically 64%. If you caught every twist and turn, every time the market moved. Of course, no one could, but this gives you an idea just how wild it was. And so again, looking at this from a daily perspective, there's no way that we can detect this. So what do we need to do? And in fact, I've talked about this right during that time frame in one of our pieces at Cap Thesis, when to use short-term charts now, because we need to zoom in to find any sense of a formation being constructed. And so doing that, this is again what we wrote in the piece, why is it the right time to use short-term charts? And as crypto traders, I'm sure you all look at short-term charts a lot, so this will make a lot of sense. Volatility is fierce, and the only way to detect bullish patterns in the very early stages of a potential comeback is to zoom in. In doing so, again, zooming in from this daily chart first, we can see that after that key low here, after the huge rally, April 9th there, we finally got the first sense of an inverse head and shoulders pattern and eventually got hit. Now, it wasn't that easy because initially thought this may have been a double bottom or a cup and handle, but guess what? It got violated right away. Huge downturn here, but we can't give up on it because we know eventually we've seen this so many times in history that's going to work, and that can set the stage for a bigger foundation. And in fact, that's exactly what happened, right? Hit that 5840 target by mid-May, eventually setting up new bullish formations on a daily time frame, right? Had an initial test here in the end of April, all held, eventually hitting the 6125 target. The even more bullish pattern started to form, including 6555. Now, this one I want to talk about just a bit because I got a lot of pushback during that time frame. We can understand why, right? This is that same rally. S&P was already up 18% in just about 4 weeks, right? And again, nothing tariff related was really decided at that point. A lot of indecision, a lot of people nervous about what could come. Not to mention, you just rallied right back in to this resistance zone that prevented the market from rallying, especially here in March, right? If you recall, kind of a head fake here and up being a bear flag. That was faded obviously extremely hard. And this was, former support, now resistance on the way up. Even if we got above that, again, people were very concerned that the 6100 area would not get overtaken because, again, you can see it failed 5 different times there. And so as we go forward, the other part was that it would mean we'd have to rally another 15%. More importantly, to levels we've never seen before. And I remember asking my followers on X about, like, where's the next 10% going to come from? Is it going to be up or down? And majority said down. And you can understand why. It's recency bias. We were just there trying to anticipate a market being 10% or even at this point, 15% higher, and to the point where going hundreds of points of S&P 500 points above where it was, very difficult to conceive. That's why paying attention to your process makes so much sense, because eventually, of course, that got hit. And then from there, another 167.45. And then going forward, on a 2-hour time frame, eventually got to 6,900. But going back to here, this was an important time because it was our highest target from a big bullish pattern. And when it finally got hit, basically talked about it in a piece on October 3rd, saying that it's now a jump ball for patterns because had numerous targets been hit. We got obviously pretty extended at this point. So what do you need to have additional bullish formations constructed? You need more two-way volatility. And of course, this was a prime example of that. But of course, that's what happened as well as we went forward. And so started to see then failed bullish patterns here, right? We just saw that 6,900 target get hit. This is when things really started to change. And as we'll look at in a second, more two-way volatility came back. And this was the first time we got a negated bullish pattern and just was like, at this point, okay, it's not working, breakouts. We have to at least step back and wait for this, at the very least, to work its way through the system before getting more bullish once more. So in terms of live bullish patterns right now, live, looking at this from a 60-minute point of view, again, zooming in to get this, currently have, this is kind of a messy chart. I would agree with this, but again, trying to look for a semblance or structure. And this, of course, looks like a bottoming formation. And so start of the day about 60 basis points above this zone here. And in fact, will get us to a potential target above 7,000. Now, getting to that target is one thing, but seeing, again, a bullish pattern work out on a very short-term basis at first, that just gives us a lot of knowledge that maybe another foundation can be built, and that's how we can get to new highs. So in terms of potential patterns, again, what do we need to see for a big potential bullish formation to take shape? More two-way volatility. So this is about 6% drawdown here. So as we know, all we have to do is add a potential breakout, take the height of here, put it above, and we can get considerably higher, say 7,400 or so. But again, we're not anticipating this. We just go by these rules. So we're waiting for this to occur. If that breakout does happen, we'll respect it. If it doesn't, we have to respect that as well. So these next two we always look at together, and we understand why. Again, low frequency of 1% moves. Why do we talk about that? Well, it's a way to measure two-way volatility. If you think about volatility, what's the first thing that comes to mind? The VIX. What happens when the market crashes? The VIX goes up. What happens when the market goes higher little by little? VIX goes down. What happens when the market S&P 500 equities spike? VIX goes down. But should it? Right? Because if we have a lot of big moves, both up and down, that says there's volatility. And so what the VIX doesn't measure is upside volatility, right? And that's what this captures more. And so we track this just by looking at the number of 1% moves on a rolling monthly basis. And as we know, 2025 has been all over the place for that matter. March and April, no surprises, a lot of them. In fact, this is the first time since the middle of 2022 that we had 12 or even more than 10, 12 in a month. And so as that was happening, it was like, well, this came after 2 straight months of 20% or 2 straight years of 20% gains for the S&P 500. It makes sense that we'll have to have, a different kind of environment this time. But of course, that completely flipped when May started. In fact, in July and September of this year, we had 0 1% moves in either direction. And that had not happened since December 2019 for a single month. To go back to 2018, 2017 to see various months of that. So completely different. Character completely changed. But guess what that did? Helped bullish patterns start to work once more. And we can compare that to 2022 again. We saw this pop up. It was like, okay, here we go. We're going to be in for a tough year. Even if the market rallies back, it's not going to completely flip character-wise, but of course it did. And so initially it looked like 2022, just from this angle, right? A lot of 1% moves. You can see by the end of the year, almost 130. Even more interesting, just about an even amount of 1% gains and losses. So it's not like we need a lot of 1% gains, because why? Those always happen in response to big down moves. This is why you don't want too many of them, but of course you want more on the plus side. This is exactly what happened in 2023 and 24. As we can tell, the total amount between 66 and 54, basically half, less than half of what we saw on a total basis in 2022. And so again, no surprises that we're up about 16% for the year, with now this looking much more like the data that we saw in 2023 and 24. Another way of looking at it, this is where we just share this simple data sheet every morning as well. This is just what's happened over the last month. If we go even back to October 10th, remember the S&P was down 2.7%. Right after, again, a few days after the S&P hit that final target, we've had now 12 1% moves up and down over the last 6 weeks. So that's a lot. We just talked about 12 within, a monthly basis. So we're still dealing with this, even though there's bullish patterns being formed. I would argue that if these number of 1% moves like this continue, they're not going to work out. Those bullish patterns eventually will get negated because it will just tell us this two-way volatility remains fierce. And the way of looking at this, right? No surprises. This is what it looked like from the beginning of the year all the way through April 20th. Now, I have that classified here, not the low, because in my opinion, this day right here and what happened afterward, April 21st, was the most important period of the entire year because this showed us, right? This was a huge down day, almost 3% down after, again, coming back from the big rebound. This had very likely, potential to completely roll over once more. And when that didn't happen, we saw then huge response to it. That's when things changed. So this is what it looked like up to that point. No surprises, a ton of them, all on the way down, many more downside than upside. Needless to say, the market was down about 20% in a short amount of time. Since that point, again, this is that April 21st low, 3 straight gains. And then from that point, things really changed, right? Hardly any 1% down moves all the way through the beginning of October. This was July, we talked about, September. Needless to say, we had a good market because of that. And since that point, again, here are all 12 of them. Not surprising, once it started, we're just about like at the same price level as we were back then with a lot of back and forth movement with it. And so bullish patterns weren't working. Some bearish were, depending on where you looked. But for the most part, this is a frustrating time from both sides, right? If we just had to wait for this to go through. And this next chart is actually my favorite one to show this. Again, what this shows is going back to 2024. Again, all the 1% moves in here all happened, right? As the market was pulling back and eventually came back. This is 2024 in May. Came back, and once it broke out from this really difficult trading period, what happened? Hardly any 1% moves. Same thing after coming back from August, September, later in the year. Head fake, of course, the beginning of 2025, but coming out of it, again, this is April 21st. What did it do? Give way to much more consistent, ultra calm uptrending action. So if this is going to be the case again now, if we are due for another strong finish to the year, potential start January, we're going to see it here. We're going to see a lot less 1% moves. We're going to see now a breakout to new all-time highs, which then lends to a more calmer, consistent uptrend. And guess what? If it doesn't happen, then we know that characters change much more. Maybe we are due for a bigger drawn out bear market. So frequent closes above the intraday midpoint. So as we can see here, this is about there's 23 trading days going back to here. And over this time frame, the S&P 500 closed above the midpoint 14 times. So pretty good clip. And that includes this period here when we closed below it 5 out of 6 times. So why is this so important? Again, short-term activity, I think, is important. We can't ignore it. Again, a lot of this is because of my time as a trader, 16 years. And the reason is this. You're a big portfolio manager, hedge fund manager, what have you, and you're bullish. You think the market's going higher. What type of trading strategies are you going to employ? Are you going to be patient and put a limit and just wait for something to come to you? No, because you don't think that's going to happen. You're thinking, much further in the future. So you're going to be utilizing strategies that allows you to participate and not kind of make ripples, right? Meaning that, if you're an institutional sales trader, a very easy thing to look at is using a intraday VWAP strategy, right? You just want to match that volume weighted average price for the day, and you're just going to participate because you anticipate not only the stock price being higher that day, you anticipate it being higher 2 weeks from now, a month from now, 5 or 6 months from now. And if you have thousands of huge money managers doing that same type of strategy, that is what gives the underlying bid every day, and that's what causes good closes more often than not. And so before we get to the bearish patterns, I want to talk about one particular year, 2017, that really changed how I look at the market. And this is really the crux of how all of these 5 traits started. If you remember 2017, it was extremely consistent. In fact, measured by a pullback off the low, this was the most consistent uptrend in the history of the stock market. S&P stayed within 3.5% or 3% of its high for a total of 15 months. So the beginning stages of or late 2016 and the beginning stages of 2018 as well. So very consistent as we can tell here. And remember, this was coming after President Trump was elected for the first time. And regardless of what your lean politics are or what you think about him as a person, there was a general understanding that the market was not going to like the uncertainty and that we probably due for probably one of the most volatile years, not least volatile. So all along the way, everyone, including me, again, 2017, I was now the firm's head technician and also trading still. So I was under a lot of pressure to try to determine when this market was finally going to roll over. And so using the traditional measurements of RSI didn't do much. Look at how many times that the S&P not only hit overbought territory here, stayed there. And once again, October, November, December especially, didn't work. So it really took some time, and I said, I must be missing something. What exactly is not happening now that we've seen at other times the market's rolled over? Well, these were all the potential topping formations that went through. Basically, every time the market paused, we could have called it a topping pattern. So the next stage of a bearish pattern is what? Seeing a breakdown. Breakdowns never occurred. And that just meant the market continued. So the last and most important part of this, failed bearish patterns. And so this is what it's looked like ever since June. We can go back to April, same type of thing. Potential bearish patterns all failed. This last one had two of them, pretty substantially lower prices, 63.60, 62.20, both negated. And this is what it looked like just going back over the last few months. Same type of thing. Every time the market just pauses, we look for bearish patterns to form and fire, just haven't worked out. So coming in to today, again, show this chart to our clients or this table to our clients every morning as just a guide, right? This is the stance. If there's more bullish patterns working or in the system at least live, we're on the right side of the market. For a while, we had two downside targets here, I should say, for a very short while, 2 or 3 days, and this didn't work out. So currently, though, we're still looking at this. If for some reason the market completely rolls over, this still could be a bearish top, and this is pretty big, right? People could argue that this is not a symmetrical pattern. Again, it doesn't bother me. You just have to identify if it looks toppy or not, right? And so far, these have not played out. So again, let's review. Now we're looking at this just over the last month of trading. We review this every month for our professional clients just to give us an idea. And of course, it changes from time to time. So as of right now, have we had any successful bullish patterns over the last month? No. Have there been a low frequency of 1% moves? Definitely not. More 1% gains and losses over the last 2 weeks, yes, but over the last month, no, they're even. Frequent closes above the intraday midpoint, yes. Failed bearish patterns, yes. So we're still in trading range, right? We're still below the highs. Still have yet to see a bullish pattern, target get hit. But we're right there potentially going. So I would say, as of right now, over the last month, the S&P is not in an uptrend. Could be again soon. And that's what we'll be looking at. And so I'm going to touch on this, and then we'll get into Bitcoin. And Adrian, stop me at any point if you want to jump from here. But
It's all right.
Okay. So one of the things I'm using recently is the go no-go indicator developed by Alex Cole and Tyler Wood of the CMT. And I think it's very interesting. So it's a proprietary system where they look at many different technical indicators and moving averages, momentum, so forth. It's proprietary, so we don't know exactly, but they put it all together so we don't have to look at all these things sometimes. And it gives you a very good indication visually if the market is in an uptrend or not. So I use this to complement those 5 traits. And so when it's in blue or green, bullish, obviously when it's in purple or pink, bearish, and when it's in amber here or orange, it says potential inflection. So as the market was pulling back, that happened, before those bearish patterns started to fall apart. So it got me concerned. Now it may be whipsawed again, which is fine because same type of thing. Remember, we talked about how this looked like 2023, 2024. Same type of thing happened here. This is the first pullback in April 2024 from March to May, actually. It got whipsawed again, and the market continued higher. And again, this was very similar to what we just had, 4 or 5 months up, right? First pullback triggered this, just said that it was on the verge of rolling over, and it did not. That's one scenario. Now, a bear scenario was this, 2018. Now, remember, we talked about how 2018, you may forget, but this was a very, very calm period from the summertime right until the beginning of the fourth quarter. In fact, we had 3 straight months, 0 1% moves. Very rare in between 2 volatility events. And then things wouldn't change there that really led to a fallout. So far, just given how strong the bounces have been over the last few days, it looks more like 2024 than 2018 at this point. But again, this is a changing mechanism. And so this can also be applied to the weekly. And I'll just show quickly how it takes some time, but was flipped to bullish just when we're getting those bullish breakouts. If you go back in time, again, after the market came off the low, but what typically happens in this indicator on a weekly basis, it leads to strong movement for years afterward. Okay, so for Bitcoin, we can't apply all those different parameters because it's a different animal altogether, but these are the ones I've been using. Successful bullish patterns, failed bearish patterns, and bullish go, no go. I'll try to get through this in a few minutes so we can have some time for questions. Needless to say, what was working on the way up? Strong bullish patterns. You can call these, bullish falling wedges. We can call them pennants, flags, whatever it is, weekly basis. When we had a consolidation for a few weeks, we saw the breakouts. And those breakouts led to strong follow-through moves until the last few months, right? As we know, everyone knows here, of course, very difficult time getting it back above 120,000 zone, eventually gave way to rollover. Saw this as well most recently. Saw that breakout in the summertime, looked like it was about to then replicate what we saw last year. Just couldn't get there. That was negated. So a big bullish pattern negated. And if you look back, of course, the last few times it occurred, it looked really set up to take advantage of this. As we know, October, huge positive seasonality in Bitcoin's history. And knowing that the last 2 times it did that, again, the last 2 years, is forming a very similar looking pattern, this rollover, of course, caught a lot of people out off guard. Live bullish patterns, you have to zoom in for this as well, right? And so try to identify this for our clients 2 weekends ago, saying the first indication of a higher low, got an upside target, now working on the second one. Again, this is a 2-hour time frame, very small, but if this is going to work, we're going to see something like this play out over and over again. So seeing how this recent flag or Darvish trading box, as I like to call it sometimes, works out is going to be very important over the next week or so. So in terms of potential bearish patterns, bullish patterns, this could be one thing, right? If this market continues to come back, if it takes advantage of the risky assets fourth quarter seasonality, then it could get there. But again, this is a big move even for Bitcoin's perspective to get there that quickly. But again, it's a scenario we're just laying out, and we'll see how that plays out. Failed bearish patterns. Well, that did happen a few times, most recently in June, August, right? And that led to some strong rallies, but as we know, those rallies failed. And then the last bearish pattern did play out. As we know, that really took off. So right now, right, the pullbacks along the way created RSIs in the 30s, but not oversold. Of course, that's changed now. So this attempt can still have a while to go, but at some point, it's going to deal with all those resistance once more. And from a go, no-go daily perspective, again, whipsawed again. I would say this obviously gives a lot more false readings than the S&P 500, just given the volatility. But when things really take off, of course, this is what it did to that indicator. Now, from a weekly perspective, this is the most concerning part. So what flipped to bullish in early 2023 and stayed there. One part here in the middle of 2024 was potential inflection, but that was quickly negated. And again, this is the same time when the S&P was dealing with that 6% pullback. And so the most recent action now has caused a full no-go after, again, a very strong run. If you go back over the years, right, late 2021, 22, same thing. 2018 doesn't nail the top, but it can nail pretty much a lot of the ensuing downturn that has come. So looking at the uptrend traits for Bitcoin, successful bullish patterns, nope. Failed bearish patterns, Not right now. Last one again. We're going by the last one. Worked out. Bullish, no go on a daily and weekly. No. So needless to say, Bitcoin is not on an uptrend either, and it obviously looks worse than the S&P 500. So how do we get to a path to an uptrend? It really starts with how the smallest bullish patterns are dealt with, because eventually, we can make the case that this could be the left shoulder of a much bigger head and shoulders right here, right? Getting back above 96,000. If we actually get there, that'll be a much bigger base that we can look at on a daily chart, and we'll see how that plays out. We saw how it worked for the S&P 500. And of course, Bitcoin is leading indicator for the S&P 500, especially on the way down, right? Topped about 3 weeks before earlier in the year, topped again a few weeks before this time. As you guys know, it tends to, or at least recently, bottomed with the S&P. So again, very important to see how both of these do. And we know that, it just fluctuates much more violently than the S&P 500 does. So if this is the case, maybe we do see it in a stronger rally to get it back close to where it was on a year-to-date percentage basis, if that were the case. And lastly, or this is what it looks like, of course, going back to 2017, very highly correlated. As we know, they don't move in opposite directions for long periods of time. So a rubber band that's stretched now is going to snap back at some point. Just a question of which side is pulling which. And then Bitcoin versus gold. As we know, Bitcoin has done a great job outperforming gold. So that has changed for two reasons. No surprises, because of Bitcoin's underperformance so far and gold's outperformance. So seeing this potential rally after getting oversold again versus gold will be very telling as well. That's the formal presentation, my friend. We can go through some contact information in a little while.
Love it so much, Frank. What a masterclass. Wow. Let me put us back on a screen for a moment. I'm impressed to say I'm impressed. It's an understatement. There's a lot of course, ways to look in the market wrinkles and ripples in the end, and that's, I think, the whole funny thing about, charting and trading, that in the end, we all see different patterns and different venues, different avenues, I should say, for the markets, trading that, even though we're looking at exactly the same charts. And I think there's a whole beauty and art to it, right? Which is why technical analysis is considered some sort of like an art to an extent, even though there's a lot of quantitative measures. Even though we are running out of time, we still have kind of like, one quick question, if that's all right with you, Frank, before we wrap today's session. So if we put it back on screen, there's been a very, very, very nice comment. We need more people like you, Frank. So I couldn't agree more. Do you follow news or just technical charts?
Well, I think we can't ignore the news. I think we have the blinders on to what the news may say, right? There's a very easy way of looking at it is, the reaction to the news is more important than the news itself. And that's true how many times? And, the other saying is that, stocks are not companies. They can operate in many different ways. And we've seen this now how many times when the market crashes and spikes. Does GE do anything different in the course of 3 months that causes it to move 30% at a time? No. But I know from, being on the brokerage side and working hand in hand with fundamental analysts, I'll give you one quick story. One of the analysts at the time was the only Apple bear on the street, right? He would get calls from CNBC because they just wanted to hear his reasoning behind it. So I remember I was looking at Apple as it was like trying to break out. Of course, one of those times I mentioned, John, I think that Apple's about to break out. I'm like, I know you have a sell rating on it. I just want to give you a heads up. And is it okay with you? You're the man here, on the research side. Fundamentally, I don't want to go against what you're saying, but I want to, write about it. So I was kind of nervous of what he'd respond with. And he said, please write about it. People will stop asking me about it. And plus it would, give people a reason to be bullish from a trading perspective. So people do understand it and they do react. And I'm going to say some of my biggest and most loyal hedge fund clients are ones that strictly use fundamentals and base their stuff off of news, but because they know at times the price action is going to matter more. If you think about it, that could squeeze out extra % of alpha per year. Huge difference, right, for their clients and how that fund is viewed.
Yeah, I love it so much. And well, for everybody who's watched this masterclass, I think it's a very eye-opening. It's a very simplified framework, not only for identifying the uptrends, but also for really understanding, what an uptrend is, what is not an uptrend, so to speak, right? And it seems that not only there's a lot of mixture, there's a lot of confusion in the market, but also even more so there is a proper inflection on Bitcoin in this framework, which I fully agree with, by the way, right? There's a whole bunch of reasons. That also our other guests, to the Trading Congress, highlighted back in the day. But more likely than not, we've been in an uptrend for some time, and for what is what, Bitcoin moves pretty much now institutionalized even more, like a traditional 4-year cycle, presidential cycle asset, and then on top of that, there's the 4-year halvening cycle, if you will, right? There's a lot of debate going whether a cycle extension is real or not. However, regardless of the debate, the market took a proper nosedive at around 37% down. So we can have debates, we can have a lot of discussions about what market do is ultimately what people like Brian Shannon says only price pays, right? So or price is king. So in the end, we can have debates, we can have discussions, and watch the whole market just nuke down, as it typically happens. So we've ran out of time, Frank. I really wish that we're gonna have another session in some time soon, because there's a lot of admiration and a lot of reasons why I have so much of the look up into what you do, and I'm truly grateful for that. For everybody who's not following Frank on Twitter, make sure that you go and follow his handle at Frank Capillary, exactly what his name and surname is. Go ahead and search for Cap Thesis as well, which is capthesis.com, which Frank highlighted just a second ago. Make sure to go ahead and just check around. What Frank is doing, incredible work, and putting a lot of difficulty in a simple sense. I think is an incredible edge in this market. And Frank is really doing that great in this market. So thanks so much for coming over to today's show, to this edition of Trading Congress, Frank. Well, what can I say before we run? It's Friday. As a matter of fact, it's a Black Friday. So even more so, I incline you to go ahead and check, capthesis.com as well as thebourbonist.com, which both have pretty nice price slices, as I assume. Frank, thank you so much for coming over. I appreciate it.
Adrian, outstanding. Thanks for having me, and best of luck with the rest of the Trading Congress. I know it's going to be great.
Thank you so much on behalf of the entire The Bourbonist community. Incredible presentation. Thanks so much. And ladies and gentlemen, don't run away just yet. We're going to have another session with our technical and trading team right in a second. So don't skip your monitors. Don't turn back. We're going to catch you right in a moment. God bless you. See you around, and bye-bye.